But the IMF is projecting that Ghana's debt-to-GDP ratio could reach worrying levels by the end of the year. In its fiscal monitor report, the fund projected the debt-to-GDP ratio to reach 90.7% by December 2022. Here's George Yafe with more.
The projection by the IMF could mean that Ghana's debt-to-GDP ratio peaked at around 68% ending July this year, with the actual numbers at around 402 billion Ghana cedis could be going up further in the coming months. The IMF puts Ghana's end-of-year revenue to GDP at around 14.1%, a level that is described by some as not so good for a low-income country like Ghana, looking at the country's rising expenditure and debt levels as well. The IMF's projection is coming at a time that the World Bank in its Africa report is also looking at the debt-GDP ratio hitting 104% at the end of this year. But government has maintained that with the economy still projected to recover strongly and measures being undertaken to reduce the debt levels, the country wouldn't reach those crisis levels at the end of this year. The World Bank and the IMF are currently carrying out a debt sustainability analysis on Ghana, a move that will give us a true state of Ghana's debt and whether we have moved from a high risk of debt distress to a debt distressed country.
Well, Head of Research at IC Securities, Courage Mati, joins us for a discussion on this projection by the IMF. Good afternoon to you. Grateful for your time, Courage. 90.7% debt-to-GDP ratio, an indication of how bad our economy is. Is it also an indication we cannot avoid debt restructuring? Your thinking?
Good afternoon, Daryl. Thanks for having me. Yes, it's an indication of how low we have fallen. And it could also be an indication that we might not avoid the case of debt restructuring, especially if we continue on this baseline forecast. And I think a bit of context is important here. First of all, the composition of the IMF debt that they recognize appears to be slightly always higher than what the government of Ghana would recognize. Because even if you step back a bit to 2021, the fiscal monitor is showing a debt-to-GDP ratio of about 82%. Now, the government numbers show about 78% at the end of 2021. The slight departure here is that the IMF tend to look at other debts that the government thinks they have offloaded to SPVs. So that's a bit of context as to why we have this kind of high numbers. Secondly, these forecasts are baseline forecasts, which means that if nothing is done, we are hitting that levels. And as things stand, it appears we are trending towards that levels. And that is why issues of debt restructuring have become very intensified in the market today, because that is what you need to do preemptively to avoid a case of defaults.
Well, meanwhile, the International Monetary Fund is forecasting a fiscal deficit of 9.2% of gross domestic product for Ghana in 2022. Now, this is despite a significant cut in expenditure and expected improvement in revenue, and it appears we are not making progress in that fight too.
Well, yes, in the views of the IMF, and this is a forecast for end 2021, and 9% or 9.2% appears quite steep. In our view, but of course, it tells a bigger story of how very, very likely it is for the government of Ghana to overshoot its own target of 6.6% that is set for themselves this year. So even if you don't get the 9.2% that the IMF is currently forecasting, there's a high risk that the government would exceed the 6.6% target they set for themselves this year. And that's largely based on the fact that at the end of 9 months this year, the deficit outturn was about 6.4% of GDP against a target of 5.0%. So at 9 months, we already exceeded the 9-month target. And for the rest of the year, 3 months to the end of the year, if you're going to hit that target, it's a tall order. And that means that there's a high risk of exceeding the government's 6.6% of GDP. As to whether we reach the IMF's 9.2%, it's a fingers crossed situation, but it tells you that there's a high risk of we exceeding the government's targets.
I want us to talk about the cedi because it's also in a crisis. Before we got to the air, there was information the local currency was going for 11 cedi 65 pesos to the dollar. Now, this is scary, Courage. The rate of decline.
It is, Daryl. It is, and it makes it difficult to sell Ghana out there as an investment destination because every investor, if they are offshore investors or non-resident investors, the key thing they care about is the currency exposure, macroeconomic conditions or stability that they come into. So if your currency is not stable, they're exposed to too much risk that their balance sheet can take. And so it is scary. Now, it appears what is driving the city at this point now is gone beyond the fundamentals, the weakening of the economic fundamentals, because we've also seen global investment houses who have also seen the city's pace of depreciation as too fast for the kind of situation we have. In fact, I've seen one that thinks that the city is about 20% undervalued. So essentially, it comes back to the negative sentiment on the market, a bit of scramble for the US dollar as a safe haven asset. And that's also intensifying the pressure on the local currency, especially as there is no clarity on what government is doing with the fiscal situation. Now, typically, if I earn coupon on my Government of Ghana bond holdings, or if I earn my salary, I reinvest part of it into Government of Ghana securities. But now, because the clarity is not there around what will happen to investment in Government of Ghana securities, given the talk of restructuring, investors are rather holding safe haven assets and seeing the dollar and other foreign currency as alternatives to CD-denominated securities.
You talk about the fiscal policies and the fact that, we are not seeing them come through. It appears you're waiting for the IMF program, and that is our only way out of this. At least that's what it seems. We're headed to the festive season, and I want to bring this up. The Ghana Union of Traders Association warning of a shortage of goods because they don't even have money to import.
Yes, and it is also a situation that is worrying. Because if you consider the fact that inflation is supply side driven a lot of these days, if they don't get the goods in, then we might also find shortage on some of the items on the market, and that could sustain the price pressures from the supply side. But then, of course, you also notice that if the cedi has depreciated by over 40%, that's a significant loss of capital. So that the same thing that you used to import, you might not be able to import it given the same capital. The signs are already showing in the data that we saw from the MPC at the last sitting, where if you check the non-oil imports, you see that on a year-on-year basis, non-oil imports had declined by 3.8% as of August this year. That tells you that something is going wrong in the trade or international trade sector. And if the imports are critical for economic growth, you will likely see spillover into economic activity and growth slowing down in the near outlook.
People don't like when we quote these rates because it fuels speculations, they say. To what extent do you think speculations are accounting for the free fall we are seeing?
It's accounting a lot in the numbers. Now, that is not to discount the impact of the weak macroeconomic fundamentals we have. If you have deficit of these levels, if you have inflation nearing 40%, these are going to drive demand for foreign currency or will cause a depreciation of the local currency. That notwithstanding, of course, these are triggers for the speculation. So once you bring in the argument of speculation, it becomes a valid case to look at. So I would not rule that out. And I said earlier that there's a scramble for foreign currency on the market, not just because it is really needed, but just because you want to store investment or capital in them because of the speculation around what will happen to Government of Ghana debt portfolio and the outlook. So really, yes, you can't rule out the case of speculation driving the currency down south.
And inflation also going up yesterday, based on the announcement by the Ghana Statistical Service, to 37.2%. The policy rate hikes obviously not making much of an impact there, Courage.
So it appears, Darrell, so it appears. And I think this is the point where we need to emphasize the need for coordination between fiscal policy and monetary policy, because this lack of coordination tends to undermine the effectiveness of monetary policy and all the policy rate hikes we've seen. And where there is no coordination between monetary policy and fiscal policy, the costs incurred to bring down inflation tends to be very high. So you don't want to keep having a situation where the government is overshooting its budget deficit and the central bank is left with no other option but to continue to accommodate this excessive deficit in terms of monetization of the deficit and undermining the policy rate hikes or the effectiveness of the policy rate hikes we've seen in the past few months. So you want to see proper coordination between the fiscal policy and the monetary policy. Fiscal policy should come back on a tightening course. We need to see that signal strongly in the 2023 budget that will be presented in November this year.
Well, one last question, because I'm concerned about the optics. I mean, we've got this news about our debt-to-GDP ratio, our fiscal deficit, the inflation going up, the CD not performing too well. You mentioned about how this has the potential to affect investments. How significantly?
Well, very significantly. I mean, if you look at the capital and financial accounts that we have currently as published by the Monetary Policy Committee, what you notice is that as of June this year, we had recorded a deficit on the capital and financial account at a level of 1.9% of GDP. Now, if you flip that back to the same period last year, we had a surplus of over 3% of GDP. Now, this is where the differences in the macroeconomic conditions matter and how the outflow of foreign portfolio investors are triggering, are weighing down the capital and financial account. So if you have a exchange rate volatility, unstable macroeconomic environment, it makes investment unattractive and people start to disinvest. And that disinvestment is what we see in the capital and financial account. So it can be very significant because the impact is the deficit we have on the capital and financial account compared to a surplus at the same period last year, which has also drained the reserves to less than 3 months of import cover, specifically gross terms 2.9 months of import cover. And in net terms, I bet is below 2 months of import cover at the moment. And because we are losing investment, and that's what the currency instability can give you.
Courage Mate, thank you so much for your time. Head of Research at IC Securities. Appreciate your insight